All right, welcome everybody. This is Axel, and as you can see, I'm playing with a new piece of technology here. And now you may see me. Welcome everybody. And today I'm sharing with you our chart book, our US equity market chart book. As you may be aware, Nick Rees, our senior analyst and portfolio manager, is working diligently on producing several different chart books on the US equity markets, on the Federal Reserve, on the business cycle, and comprehensively together, the idea is to give investors the opportunity to have a cross-check of their own process, having something that doesn't have the clickbait of your typical coverage that's happening out there. And so we record this ahead of time, ahead of publishing it, because we do have to go through various compliance processes. So we recorded this yesterday, and I'm about to play it. If you like it, please go to merkinvestments.com/research and browse around. You can download a PDF of this there. We do have a premium section as well, and usually the video you're about to see is an analysis we only have available in the premium section. So please enjoy this, and please give us your feedback. Welcome, this is Axel Merk, President and Chief Investment Officer of Merk Investments, with the latest US equity market chart book. I am recording this live to tape on Tuesday, the 12th of November, about half an hour before the market opens. Please download the PDF so you can study this wonderful quote and other things in detail. Here's my in-between the line readings and partially repeating what Nick is pointing out. He's pointing out here the earnings momentum has stalled in it's expected to resume to have earnings move higher next year. The goal, of course, of this entire exercise is to see where are we in the equity markets. We see this in the context of our other chart books, where the business cycle is, where the Fed is, and the business cycle chart book is kind of, if you're in a positive business cycle environment, that tends to be, historically speaking anyway, positive for stocks. The Fed hugely influencing what the market is doing. And then this is kind of a little bit of a summary, more focused more specifically on the equity market, but it should be seen in the context of the others. Business cycle is still positive here. What is negative, has been negative, is the global growth backdrop, is the purchasing manager indices on the manufacturing side here, notably below 50. All the major economies are below 50. The green shoots, if you want to call them such, is the US has ticked up here. Germany notably has ticked up. Big question is, did we actually have this mid-cycle slowdown that Powell talked about? And just to take that up front, I happen to agree with that. This might be a mid-cycle slowdown. I did not agree with the fact that we needed these interest rate cuts, but it doesn't really matter what I care. It matters what happened. Financial conditions. If you look closely here, the ticking higher means easier financial conditions on the grayish line. They had been ticking down just a tad, and for context, this is one of the key reasons why I didn't think the interest rate cuts were warranted, is because you can't fix trade policy with rate cuts, and financial conditions were easy throughout. Market breadth on the technicals. There are just a few technical charts here. The short of it is the technicals look just fine, thank you very much, reaching new highs in the S&P and several other indices with very significant market breadth. This is a market breadth chart that Nick developed. If you're not familiar with it, please look at it offline. If you study it in more detail, we have this imaginary line here of 65, suggesting if we do drop below, then the market breadth may be deteriorating. And it's kind of natural that as one is aging in a bull market, that the breadth is weakening, but the breadth seems to be doing just fine. Market sentiment, which was quite negative not long ago, has now bounced back, a contrarian indicator. So here, again, we have a mixed bag. Some indicators point positive, some negative. If you want to read something positive into this market, you probably can. If you want to read something negative into the market, you probably can as well. The I'm not going to go much here into this correlation framework. I studied that offline. The short of it is we're not at extreme values. This tends to be very noteworthy in extreme environments. The wall of worries is, we have few things to worry about, although there's always plenty. But again, as a contrarian indicator, if we don't have too many things to worry about, that's a bit of a concern. Most recent past has been more positive. And to provide a little bit of context here, the incentives of the president are to put some tailwind into this economy. The raising of the tariffs provided headwinds. Global PMIs deteriorated more strongly. U.S. indicators, several of them turned negative. If the president wants to get reelected, then he has an incentive to create tailwinds. And the one lever he has, of course, is his trade, where he can ease conditions. The question is really, is it enough? Is it enough? Notably, business investments is one of the key things that can make the difference between expansion and recession. And can the kind of phase 0.9, 0.95, 0.99 deal, and this the step-by-step things encourage people to invest. Now, my own take is that it's in the interest of the president to reduce trade tensions, but it's also in the interest of the president to keep trade in the news. So it's completely natural to expect these tiny baby steps. What may not be so natural is the drama that goes all around it, but that's our current president. On that note, Powell had indicated he will not lower rates again unless there's something very substantial, significant happening. He will be testifying this week twice, and since he has emphasized consistency, he might just come across as hawkish to hit down that point. But that said, he said something substantial might change his mind. On a rational basis, this may well be if high yield spreads blow out, go up substantially. But to be a bit of a cynic here, I just mentioned the president a few times. A tweet could be quite dramatic and could have a dramatic impact, since we have a president that's kind of likes drama. And while that might be a cynical comment, it does serve a more serious point, and the more serious point being that we do not have a rigid framework as to how Powell is approaching all of this. And in my view, that's not very helpful. Anyways, VIX curve is always of interest when it is inverted, because that means we're usually in a bit of a panic environment. By the way, in the premium chart book, we go into a little bit more detail and talk about the short vol trade a little bit more. That is reaching new extremes. And on that note, please do study the premium chart book. We also talk about short interest at comparison to the Chinese market. Another technical comparison, things looking fine. This one here is we call it valuation indicator. What it really is, it's the percentage of equities relative to equities plus bonds or fixed income. And historically speaking, equities are taking a big chunk of that. And if you do some autocorrelation, then that might mean that over the next 10 years, the returns are going to be kind of flattish. This, by the way, is before dividends. And it's a nice visual representation, but it doesn't really tell you what the market is going to do tomorrow. It just means that relative to fixed income equities are highly valued. A reminder that returns are a bit all over the place and never really what anybody forecasts them to be. This is, of course, in the context of this very significant sell-off we had late last year. Keep in mind regarding the sell-off late last year that it also distorted or created some interesting tidbits about other markets. For example, the year-over-year comparisons at the year end, some of them might be extremes, and we will have very significant year-over-year comparisons on oil, for example, late this year. And I'm not predicting here anything on oil, but a rising oil price tends to be associated with rising inflation expectations. And so I just mentioned earlier, we're having potential tailwinds coming on the economy. We might have higher expected inflation readings, and you would think that all this is kind of priced into the market and all that, but sometimes you'd be surprised how things then get reinterpreted and the markets are moving. In any case, the glass may look very different, whether half full or empty late this year, whether it has been just recently, and the Fed might even be inclined to suddenly be pricing into hike rates again. And now that's going out on a limb. This data certainly doesn't suggest that right now. I'm just suggesting that, yep, that these tailwinds are picking up. As far as I can see, so I'm in the glass half full type of camp right now. Bunch of things positive, a bunch of things negatives. Please do read the blue comments that this is the sort of comments here that Nick is putting in always. I tend to agree with that. That in the short term there is a slight positive bias. And of course there are always lots of uncertainties. Late cycle is the case, but right now it does seem that there are some positive things coming. Now, as far as investment allocation is concerned, this chart book here obviously mostly talks about risk assets. I like to repeat what I've said before. People like to have the cake and eat it, meaning they tend to invest in the equities, but they like to take some sort of hedge. Usually when you kind of want to be properly diversified, you would be equities and fixed income, let's say 60-40 diversification. What we see right now is that rather than people rebalancing, they take on other risky investments to diversify, be that gold miners and the like. And there's not investment advice, just an observation that people are not, quote unquote, fleeing to cash. They want to hold on to their gains. And again, we're not giving investment advice here. If you'd like to have something specifically more looking at your portfolio, we can talk about it if you reach out to us. The most important thing here is really to have a process, and maybe we can help you with your process by sharing these chart books. If you don't follow it yet, follow Nick on Twitter. Obviously, follow me on Twitter as well if you are so inclined. And as always, never miss our exciting and disclosure here. And with that, I'll talk to you at the next chart book, or maybe on social media or somewhere else. Thanks, and take care. All right, so this is Axel again. This was a recording that we taped earlier, and now it's me back. Let me know whether this format works for you. Just as a closing remark, mention that Powell speaks this week. Well, he's speaking in less than an hour, as of this right now, at 11 Eastern time on Wednesday. And to reiterate what I said earlier, I expect him to be consistent, which will also mean that he's going to re-emphasize that he's not going to change his view with regard to interest rates, which might be considered as hawkish. And just looking at the markets right now, the bonds are a tad stronger and the S&P is a tad weaker. Who knows what the implication of that's going to be. By the way, overnight, the Reserve Bank in New Zealand did not lower rates, was widely expected to lower rates. It's the strongest performer in the G10 today. And who knows, maybe we've cut the corner on the kind of the lowering of the rates. I think that might be a tad premature. Some banks, they may still want to do it, but we'll see whether I'm right that maybe these headwinds are going to turn into tailwinds with all the stimulus that we have. So with that, let me wrap it up and see whether I can get rid of my pretty face. Here we go. And I will talk to you some other time.